I'm Scott Shuttleworth from Montgomery Investment Management and welcome to this week's video insight. Today I want to talk about forecasting. If we simplify the investment process down, as investors, we typically create models to take our expectations for future earnings and derive out some sort of valuation, which we can then use as a barometer of whether the share price is cheap or expensive. However, if we were to examine history, we quite quickly find that forecasting the future with present information is very difficult. Let's take REA Group for example. If we went back 20 years and considered what information we might have had back then, how much confidence could we have had that we could have forecast REA Group to be the huge success it is today? Correspondingly, consider the fortunes of the traditional newspaper business over that time. These were highly profitable businesses with wonderful returns on equity. Given the information at that time, how much confidence could we have had about forecasting the deterioration of that industry over the next 20 years? A conservative approach to investing would start with the basis that our ability to forecast the future directly is low. Then we can think about what could occur rather than what will occur and what the distribution of future outcomes may look like. From this, an investor can then develop a range or distribution of valuations for the company which have been considered versus a rational estimate of their probability. This is not a new idea. There have been many books written about using a distribution of outcomes, but it's striking how underutilised this practice in the investment industry actually is. Let us use an example to describe this more tangibly. Back at the end of 2016, we noted that the share price of REA Group had fallen to $47. The price implied a considerable reduction in the number of properties being listed for sale in Australia for an extended period of time. Post our research, we found no reason to believe that the property selling habits of Australians had changed so drastically and expected a more normal market over the longer term. Hence, the market price of $47 in our view was based on an unlikely scenario and we attributed greater probability to the normal case. We also considered the inherent pricing power that the firm had exhibited over history, which the market seemed to not fully appreciate. Post this event, in 2017, REA shares reached almost $70 as the market re-evaluated its prior view. So whilst we weren't attempting to make a direct forecast about when listing volumes would improve, we considered the market's view as unlikely and our investors were rewarded. The flaw with this practice, however, is that just because our research determines that there are strong reasons to believe that a negative event won't occur, this doesn't mean that the event is necessarily impossible. Indeed, an investor can experience several of these events at once, and the market has delivered plenty of perfect storms over many decades. However, the solution to this issue is just that, consistency. By continuing to invest in a portfolio of rationally priced, high-quality businesses, we believe our investors will be pleased with long-term results. That's all for this week. Please follow us on Facebook and Twitter.